Welcome. My name is Piers Leslie from Fact Not Fiction Forecasting. During the webinar, I will talk about how the markets look to me from a chartist point of view. And here is a brief explanation of the techniques I will use. Moving to the next slide. How am I going to look at the markets? Well, I filter out all the noise by simply looking at the price action. If the price is wrong, it will correct quickly. Everything is in the price. Don't be fooled that it's not. I differ from an economist who is interested in the news and events, as I believe that is already in the price. By looking at the price, I might see what it suggests. What I'm trying to see is who is in control. Are the buyers in control or are the sellers in control? Once that's established, we can see, are there any trends? Once we see if there's a trend, we can look for the next targets, the targets being support and resistance. This is not so much a forecast, more of a guide to where the rate could target on the upside and the downside. If we move to the next slide, this shows candlestick charts. And the candlestick charts help to show who's in control of the market. They help us to see, is it the buyers or sellers in control? The same rules apply to any time period, hourly, daily, weekly, whatever chart we look at, the same candlestick rules apply. There are always going to be two different colors. One is where the session opens and then closes lower. That's a negative session. While the other is where the session opens and then closes higher, positive. The colored bit is the bit of the body in the candle, which is important, between the difference between the open and the close. So the square bit in the middle, that is the bit we call the body. In my examples, red are the negative sessions and green are the positive sessions. We then have spikes on the top and the bottom, and those are simply the highs and lows. The relationship between the size of the spikes on the top and the bottom of the candle is important. Moving to the next slide, we're going to also talk about something called support and resistance. Here is an example on a euro sterling monthly chart. For 4 years, we can see that the market fell and bounced off the same levels. While price is contained by the top side in those circles, we call it resistance. And when price finds a base on the bottom line, we call it support. It supports the market. It doesn't matter what time period we look at, it's the same rule, whether it's hourly, weekly, monthly, whichever chart. Now, if we move to the next slide, we can see what's called the rule of polarity. The rule of polarity is where support and resistance switch over. So if an area has been support or resistance, if it breaks through, then it becomes the opposite. So here is an example where sterling dollar, since 1985, we can see on this quarterly chart, the price always found support around the 143.25 area on the quarterly close. And we have 4 examples of that where the price bounced off that. Once it broke it, you can see that when the price rallied back up to that area, it fell off it, as it has now become resistance, and that is the rule of polarity. Now, if we move to the next slide, the last topic I'm going to talk about here is the Fibonacci retracements and extensions. So the Fibonacci extensions and retracements are derived from the Fibonacci sequence. The Fibonacci sequence is the one where you add the 2 previous numbers together to get the next number. So you have 0 and 1 gives you 1, 1 and 1 gives you 2, 2 and 1 gives you 3, 3 and 2, 3 and 2 give you 5, and it carries on in the same manner all the way through. So how do we get the retracements and extensions? They are simply ratios derived from that sequence. The main retracement extension levels used in financial markets are 23.6%, 38.2%, 50%, 61.8%, 76.4%, and 100%. One takes the start of a move on the chart to the end of that particular move on the chart. And we plot the retracements from the start to the end of that move. There will be some examples on the following slides, but just before we get to them, there are two key levels in FX markets that appear to be crucial levels, and they are 38.2% and 61.8% retracements. If 38.2% retracement holds a pullback in price action, then often the impulsive trend is intact and price will continue in the prevailing direction. If 38.2% breaks, then often the price heads back to the 61.8% level. Now, this is a very basic introduction and only for education purposes only. If the subject interests you more, then please research it on the web, just searching the word Fibonacci or Fibonacci retracements and extensions, and research it further. Now, moving to the next slide, I will show you some examples. So on the first of the example slides, we have a retracement illustration. So this is sterling dollar. And if we look at the left of the chart, you can see the low down at 114.12 in March last year. The price then rallies up, and where I put end of the move at 134.82, you can see the market starts to pull back lower. But when it pulls back lower, just in that circle, the highlighted circle, you'll see that price stops exactly at the 38.2% area, and then the market starts to rally again. That tells us the impulsive trend is intact, and we can see that the trend continues and we go higher. If we move to the next slide, here is another example. So this is sterling dollar yearly. Each candle represents 1 year. If we take the start of the move from 1980 up to the top of the move at 211.61, you'll see when it comes off that 211.61, the market crashes down with the financial crisis, but it goes through the 38.2%, but it finds support at the 61.8%. Then, using that rule of polarity, we know that support and resistance change. So when the market rallies off the 61.8%, you'll see that it stalls twice at that 38.2%, and then the market continues in its prevailing direction and goes lower down towards the 76.4%, where it trades around that for quite a few years. The final slide is the next slide, and this is an extension. So in the same way with the retracement, we can take the same move we looked at on the retracement slide. We can look at the start of the move to the end of the move, and there, where it pulls back to the 38.2%, we then plot the extensions on. We put the same ratios on, but going up. And if you look there, you can see that the market stopped at all these levels, the 23.6, the 38.2, the 50%, the 61.8%, and then it stopped at the 76.4%. We can use it like a roadmap to see where it's going. And then you can see between that 137.11 and 139.55, there's been a lot of sideways action, but it's just a good way to see where support and resistance is in the market. Now that concludes this brief explanation, and I hope that you found that useful as a brief explanation to help you understand the basis of my technical analysis presentation. However, if you have any questions, please contact your salesperson. Thank you for listening.